Hello and welcome to the LP Financial Services Forex Training Class, Introduction to Technical Analysis videos. In Lesson 3, we'll talk about moving averages. In statistics, a moving average or rolling average is one of a family of similar techniques used to analyze time series data. It is applied in finance and especially in technical analysis. Moving averages are used to smooth out short-term fluctuations, thus highlighting longer-term trends or cycles. The threshold between short-term and long-term depends on the application, and the parameters of the moving average will be set accordingly. A moving average crossover results from plotting two moving averages, each based on a different time period. The moving average formed by the shorter of the two periods is called the fast moving average, and the moving average formed by the longer period is the slow moving average. As changes in price occur over time, the fast-moving average reflects these changes by moving upward or downward with the price, quicker than does the slow-moving average. As a result, these moving averages cross over each other, assisting to define the prevalent trend. In our lesson, we'll cover the two main moving averages, the 50-day exponential moving average and the 150-day exponential moving average. When we look at moving average number 1, the 50-day exponential moving average, we see that an exponential moving average, or EMA, is a technical study which applies weighting factors to the market which decrease exponentially. It takes a percentage of today's price and adds in the prior day's exponential moving average times 1 minus that percentage. The formula for the exponential percentage is equal to 2 over the number of time periods you use plus 1. So if you wanted a 50-period exponential moving average, you would use 2 over 50 plus 1, or 2 over 51, which is equal to 0.039, or 3.9% as your percentage for the calculation. If you choose a 150-period exponential moving average, you would use 2 over 150 plus 1, or 2 over 151, which is equal to 0.013, or 1.3% as your percentage for the calculation. The idea is that the longer period you use, the lesser the percentage of today's price is regarded in relation to the calculation of the exponential moving average. Exponential moving averages are often used together with an overlay of two different time periods on one chart to help define the current trend. Can you see the 50-day exponential moving average? As we take a closer look at our 50-day exponential moving average, we see it's this blue line, and this moves up in relation to the price. And its calculation for the 50-day puts a weighting of 3.9% onto our moving average. So you can see price alone can be above the moving average or below, above and below, above and below, and this is one way to help define a trend. When the price is trading above the moving average, you could say the trend is up. When the price is below the moving average, you could say the trend is down. This can be an ineffective way, though, to define the trend, as price alone can go below, yet the trend go back positive. When we look at a downtrend, we equally see that the price can go below this exponential moving average and then come slightly above it, and then back below, and then slightly above it. This also could be a way to help define the trend. As we can see, the 50-day moving average, but it is less effective than using a combination of two moving averages to help define the trend.